Hello, and welcome to another episode of the Innovators and Investors podcast. I'm your host, Kristian Marwuez, founder and CEO of FinStrat Management. Super excited because today we have with us Phil Nadel, founder and managing director at Forefront Venture Partners. Phil, welcome to the podcast.
Great to be here, Kristian. Thanks for having me.
Our pleasure. And with that, let's jump right into it and we'll start with a bit of background on yourself. If you can tell us about your journey into venture capital and how you came to start Forefront, please.
Sure, happy to. I started and exited several companies earlier in my career. Some of them were large enterprises. And after the last exit, which was, I don't know, maybe almost 20 years ago, I started getting requests from family members to help them with their startups by providing not only advice and guidance, but an investment of money. And so I started to do that with a few family members. It worked out quite well. And then that circle expanded to friends as well, and did a few more of those, which also worked out well. And then about 15 years ago, decided, hey, I really want to do this as my full-time thing and not start another company, but help others start their companies and achieve their dreams. And so I started doing venture capital investing on a full-time basis. So that's how I came into the business.
Well, congratulations on your exits. For people in the audience, especially first-time founders, very few guarantees in life, and seeing a successful exit on a company is not one of them. So the fact that you're able to parlay that into now assisting other companies get off the ground is great. And so with that, what is Forefront's investment thesis, and how do you go about identifying high potential startups?
Sure. So Forefront invests in seed to Series B rounds in companies that are generating revenue. We have a relatively low revenue minimum, but we do have a minimum. So we're not looking at pre-revenue, we're not looking at pre-seed. It's got to be seed to Series B and generating revenue. We say that we're sector agnostic, and to an extent we are, except that we really focus on companies that are capital efficient. So that, by definition, is going to eliminate certain sectors. For example, biotech. We don't invest in any biotech because it's very research and development heavy. So there's a lot of capital expense there, and it takes a long time before you start to see some revenue. So not exactly the most capital efficient type of company. So we avoid those types of sectors. But generally speaking, we are agnostic as to sector. And if you look at our portfolio, we have about 120, 130 companies in the portfolio. It's spread across a lot of different sectors. I will say that probably we do more SaaS company investing than anything else. But combined, if you look at it, it's pretty diversified. And that's one of the things we try to do for our LPs, is to provide them with a diversified portfolio.
And so, what industries in particular are you bullish or bearish on right now?
Thematically, we look at any kind of company or technology that's solving a significant pain point, that's addressing a large target market, and is solving that pain point in a much better, like a 10x better way versus the competitors. These are mostly tech companies or tech-enabled companies, and they're solving big problems for their customers. So we invest in a lot of legal tech. We've invested in insurance tech, marketplaces, any kind of sector or industry where we see antiquated solutions, manual solutions, or just inefficient solutions, where technology can help and either save money or improve margins or save time, whatever it may be. Those are some solutions that we'll look to invest in.
And in your experience, obviously founders play a significant role in execution. So how do you go about evaluating them?
That's the tricky part, right? So everyone knows that early stage investing is all about the founders. And I would say this is a skill that is developed over long founders and trying to get a sense for who's likely to be successful. It's difficult to do, but we probably do more due diligence at an early stage than any other investor who invests at our stage, at least that I am aware of. And in doing that, we spend a lot of time with the founders. And so that time that we spend enables us to get a real sense of who they are, who the team is, what their skill sets are, where they're complementing each other, where there are deficiencies, and especially where they can use our help, all of those things. And then we spend a long time analyzing financial projections. And we do that knowing full well that the projections are never going to be accurate. And that's not what we're looking for. We're looking to get a peek into the founding team's head to understand how they think about the business, how they think about growing the business. What are the levers to growing the business? Are their projections based on some historical numbers or some realistic figures? Are their expense numbers in line with the growing revenue? All of that. So by really beating that up and digging into that and asking a lot of questions, we learn a lot about the founders through that process. And so as a result, we can form an opinion about whether we think that this team of founders is going to be successful.
Okay. And so you complete your due diligence, founders hit the mark, profile the business, it makes sense to cut a check. What support beyond funding does Forefront provide portfolio?
Look, there are a lot of early stage investors, and capital is a commodity. And so we have to differentiate ourselves. And the way to do that is the support that we provide our portfolio companies. And so what we do is, through ourselves and our network of LPs, we provide our portfolio companies with strategic advice and guidance, lots of introductions to potential customers and partners, and strategic introductions to investors for the next round or rounds. And we're always available as a sounding board, and through our network, again, of LPs, we almost always will have connections for the portfolio company that are relevant to their industry. So we'll have LPs who have experience in that sector and can provide meaningful connections and advice and guidance related to that sector. So really, we like to say that we're as hands-on and as supportive as the company wants. So sometimes companies don't want as much support, don't need as much support. And as they scale, they find that they don't need as much support from us. And that's great. That's fine. But when and if they need it, we're there for them, and we'll support them in every way we can.
So totally appreciating that every company is unique, but by virtue of taking investor dollars, there's a focus on growth. In your experience, what guidance or counsel do you provide founders on how to balance growth with sustainable business practices?
Yeah, so as I said, we are focused on capital efficiency. And so we counsel our portfolio companies to really continue to remain relatively scrappy even after they raise. So there is a fine line, a fine balance, as you've said, between growing quickly and making sure you have enough cash. The reason why most companies that go out of business do so is because they run out of cash. And you have to keep an eye on that at all times and balance that with your growth. And if it's necessary, and it certainly is in certain fundraising environments, if it's necessary to take a step back on the growth to preserve cash, then you need to do that. That's the responsible thing to do. That's the right thing to do for your investors. And you can't, we do not believe in a grow at all costs mentality. That is just not our mentality at all. And I know that's contrary to a lot of investors in Silicon Valley and whatnot, but especially in a tight fundraising environment, you really have to be careful of your cash. And that's why we really advise portfolio companies to have a KPI dashboard and very closely monitor all of their KPIs, but most especially cash flow. What is their cash and what are the KPIs that are affecting it? And really try to fine tune those month to month.
It's a great response for a number of reasons, but one of them is you answered what was going to be my next question. And I think for the founders, there's having an intimate understanding of how your business is performing is invaluable, as you point out, especially in this environment. Because my sense is before the Fed started raising rates, you had a lot of companies that just had a mindset that the money would always be there.
100%. That's right.
And you have to have an appreciation that things change. So with
Yeah,
that,
and along those lines, it's not just the availability of capital, but it's the expected valuation and terms in the round. And that's another aspect that founders have had to come to grips with or come to reality on in this fundraising environment. A lot of times they have very lofty valuation expectations, and they have to be brought back down to earth when they go into a fundraising mode.
I've heard a handful of founders say, but the multiples were this in 2021.
Yeah, yeah. A lot of things were true in 2021 that aren't true today.
That's
It
right.
had a lot more hair.
With that, so let's talk if we can unpack fundraising. So, founders looking to complete their first seed round. What advice do you have for them?
I think in terms of trying to get that meeting, that first meeting with a VC or whatever investor, even if it's not a VC, an angel, it's really important to clearly articulate what problem you're addressing, how your solution solves the problem in a better way, why your team is the right team, how large the addressable market is. Leave out all the industry jargon that investors are less likely to understand. Keep your pitch deck short. The goal of the deck, the goal of that first outreach is to get a meeting. That's all. You're not going to get an investment after your first email to an investor, right? It's a process. And every step, you want to get that next step. That's your goal. Get to the next step, get to the next step until you finally get the investment. Be patient, clearly articulate problem, solution, why you're the right team, and keep the deck brief to the point. Get that next meeting and leave out all the industry jargon that and technical data that can come later.
For the founders in the audience, the response is worth its weight in gold because my sense is that all too often expectations are mismatched between the realities of raising capital and just what investors are contending with. And so with that, I'd be curious is what your sense is how often do you think founders appreciate that you have return expectations that you have to manage with your LPs?
I think the more experienced founders generally realize that dynamic, understand that dynamic. And I think I'm flattered by the fact that many of the founders in our portfolio end up being LPs in our fund because they understand the level of due diligence that we do and the how seriously we take our responsibility to our LPs and our focus on producing not only a diversified portfolio but excellent returns. And we're very appreciative that they've joined us and flattered by that. But I do think that sometimes, I think what you're getting at, sometimes younger, newer founders, first-time founders, don't fully understand the dynamic around that. And especially when they're trying to make a case for a higher valuation and that kind of thing, they're not fully understanding that there's a balance there. We need to provide a good return to our LPs and for our fund. And we need to make sure that they have the capital to grow. So it's a balance.
And hopefully forums like this will help shed light on the process and make it a bit more efficient.
Yes.
Would love to hear your thoughts on what have been some of the most challenging and rewarding parts of being a venture capital investor.
Certainly, the rewards for me are based largely on helping founders achieve their dreams, helping them, nurturing them with building the company that they envisioned. And that, to me, is incredibly rewarding. The relationships that I've developed with LPs and founders has also been incredibly rewarding. That's probably the most important thing. That hopefully these are relationships that will continue to last for many years. The challenge is we are extremely selective investors. So we have to kiss a lot of frogs to find the prince. And so we end up having to say no to 99% of the founders that we meet. And that's challenging. It's difficult to do. It's not pleasant to have to say no to a founder. And so doing that, going through that process and being as selective as we are and having to pick from even a small group, a subset of really great companies, that can be challenging. I guess another challenge is sometimes because we have a lot of experience, we see founders making mistakes that we could have anticipated and they should have anticipated. And so we try to work with them. They don't always heed our advice. They don't always ask us for advice on everything. So we will sometimes see them make mistakes. And if they had worked through it with us or talked to another advisor or other investors, maybe they would have avoided a pitfall.
Yeah. And my experience too has been communication paramount. I also think there's an appreciation that founders should have is that not everything is going to be a bed of roses. Things will go bump in the night. And you should be transparent and candid. And I think investors expect that. And on the contrary, when they don't hear good news is, hey, are you really being forthcoming?
I could not agree more with that sentiment. And we require all of our portfolio companies to provide regular updates to us and detailed updates. And sometimes they don't, even though they've signed an agreement saying they will, but sometimes they don't do it. And when I inquire, it's usually because they have something they don't want to share, some bad news. And I say to them, look, the best time for you to be providing an update is when you need help, when you're facing a challenge. Investors want to help you, but if you don't communicate, we don't have the opportunity to help. And so you're absolutely right. Founders need to communicate with investors regularly, regardless of whether the news is good or bad. Communicate, you'll develop a relationship with your investors, and they will be there for you when you need assistance. And don't be afraid, founders, to ask for help. Don't be afraid in those updates to say, here's what we're struggling with, here's where we need help, here's what you can do specifically to help us, and make it easy for them to help. Give them a blurb that they can forward out to companies, or give them a very specific ask, but ask. And don't be afraid of sharing challenging or bad news. We as investors expect that along the way. This is the path that we've chosen as entrepreneurs. And so we want to be there to help. And so the only way we can is if you communicate and do it regularly. I have the utmost respect for the founders in our portfolio where I know on the same day, every month, I'm getting an update from them. Every month on the exact same date, I get an update.
Sage advice. And the irony of it is by having courage, presuming the business performance is there, you probably also increase your odds that you'll get participation for any follow-on rounds.
Absolutely. When we've tried to raise follow-on rounds for portfolio companies that have not been as communicative, it has not been as successful because our LPs and our investors just don't feel like they are as in touch with the company, that they know the company. They don't feel like the company's been as forthcoming or as candid as they could have been. And who wants to continue investing in a company that's not going to be forthcoming. That's why we place such a high priority on communications, is that we know, because we've been in that position, we know that investors don't want to be left in the dark. They want to know what's going on. So that's why we prioritize it.
Bill, this has been an awesome podcast. I really appreciate your insights and your
Oh, my
perspective.
pleasure.
If there are any founders, co-investors, LPs that would like to connect with you, how can they find you?
ForefrontVP.com is our website. ForefrontVP, like for venture partner.com. Or I'm on LinkedIn all the time. They can contact me on LinkedIn. So yeah, absolutely. And I publish a lot of articles and whatnot on Medium, so they can look for me there if they're interested in reading some of the articles I've written.
Good stuff. Phil, thank you. And for our audience, Phil Nadel, founder and managing director at Forefront Venture Partners. This has been another episode of the Innovators and Investors podcast. Thank you.
Thank you.